As investing and saving is falling more and more on the individual, there's a lot of different products that can help you save for retirement. One of the most popular and one that is being used more and more is the Roth IRA. What do you need to know about the Roth? How do you use it? Who's eligible to use it? How much can you contribute? There's a lot of different questions that go into this, but today we want to make sure you have everything you need to know about the Roth IRA. Hello, welcome in. This is Retire Right, a Wyze Wealth Advisors podcast. I am Ben George with Ryan Wyatt, who is a wealth advisor and a certified financial planner. Ryan, how are you?
I'm doing great, Ben. How are you?
I'm doing great. I know Roth IRAs are a very popular product, and talking to a lot of advisors, and this is a product. If anybody can utilize it, it is such a great tool for helping you save, isn't it?
Oh, it really is. Yeah. And I think it's one of those things where, some people find out about Roth IRAs and how powerful of a savings tool it is, later on in their working years. So, if this can help educate people and maybe help them determine if it's suitable to invest in earlier, or use a different strategy to get some money into Roth, then I'd say I've accomplished my goal.
Yeah, that is a great goal. If we can get one person to think more about the Roth or start contributing more to a Roth by the end of this episode, we have done our job. And if you enjoy what you hear today, please subscribe to the channel as well. We'll have a lot of educational videos coming up about all kinds of financial planning topics and conversations, again, that Ryan and Ron and the team there at Wyze Wealth will help their clients with, and we want to bring that education here to you. But again, if you have any questions, wyzewealthadvisors.com, best place to start, and all the contact information will be in the description. So before we get into a lot of the kind of the nuts and bolts of the Roth, let's just kind of start with a quick description here of what the Roth IRA really is.
Yeah. An IRA, in general, is just a retirement savings vehicle outside of your employer-sponsored plan. So it's not a 401k, even though 401ks, have the ability to put Roth money in. But this is a retirement savings vehicle outside of a 401k. What Roth means specifically is that you're putting after-tax dollars into the account. So the money's been taxed already. You've paid your ordinary income tax on it, and then you're putting true after-tax dollars to the Roth IRA. That's, in general, what a Roth is. Now, in terms of general suitability as well, or when does it make sense to contribute to a Roth or get money to a Roth? Again, this is very general guidelines here, but you generally want to think about putting money to Roth when your taxes in the future are likely, or your income in the future is likely to be higher than what it is now. Again, very simple overview there.
Okay. And we'll talk about some of that tax-deferred growth a little bit later in this episode, but I want to talk first about kind of who's eligible, because I think it's on the surface, Roth, I can go with this money tax-free. Well, I'm just going to put everything I can in there, but it's not quite that easy, right? So who can contribute and who can use this Roth IRA?
Right. So there are income limitations for you to be eligible to contribute to a Roth. So we're going to put a link in the show notes for a tax table that I very commonly refer to. It is updated based on tax year 2024 numbers, but as I mentioned, there's income limitations. The income limitations are based on what's called your modified adjusted gross income, which is essentially your adjusted gross income, which can be found on your tax return with a few deductions added back in. So there are specific income limitations as to whether you're eligible to contribute or not.
Okay. So I've seen the acronym MAGI. What is that?
So that's the modified adjusted gross income. Okay. And then it's basically very similar to your adjusted gross income, which would be found closer to the top of your 1040, your tax return. Okay. But there's a few deductions that are added back in, and that's where you get the modified adjusted gross income from.
Gotcha. Another thing I've seen is that this term phase out is in play when you talk about Roth IRA contributions. How does that work? How do things phase out?
Yeah. So not to confuse matters more, but so not only are there income limitations, but then there are specific income there's an income range where if you fall in between that income range, you can contribute to a Roth. You just can't make the full contribution that you'd be allowed to make in 2024. So let's just look at somebody that is married filing jointly. The phase out range starts anywhere above $230,000 and it ends once you're over 240,000. So what that means in simple terms is if your modified adjusted gross income is below 230,000 as a married filing jointly couple, you can make the full Roth IRA contribution. If you're in between 230 and 240,000, there's a calculation that the IRS uses, but essentially you can't make the full contribution, but you can still contribute. And then the second that you go over 240,000, you're no longer eligible to make a straight up contribution to your Roth IRA. There's some additional strategies that you can use, like a backdoor Roth, to get money into the Roth IRA, but that's a little bit outside of the scope of what we're focusing on today. In the future, I'll record a full episode on those different strategies. But again, for today, I just want to focus on that phase out range and how it works.
Okay. So you have the income limitations that you laid out, the phase out process there too. But on top of that, you can't put all your money into a Roth, can you?
No, you can't. So the contribution limit, and again, this is adjusted for inflation. So the contribution limit, or this adjusts for inflation. So a few years ago, it would have been a smaller contribution than you can make now. But contribution in 2024 is $7,000. And then there's what's called a catch-up contribution. So if you're 50 or older, you can contribute an additional $1,000 to a Roth.
So yeah, it's a nice little tool then too if you're trying to catch up. But 7,000, it might not seem like a lot, but it's not something that everybody can measure up to. But you do have a limit. You can't just put all your money into the Roth. All right, so that's the contribution eligibility, kind of a snapshot of who can use it and how you can best utilize that. Let's talk again about that tax deferred growth and kind of a little bit more about what's happening inside the account, because you hear IRA and it might not necessarily stand out to you of what the difference truly is. But when I put that money in, when I invest, let's say I use the 7,000 or whatever that number is, but I contribute my money and invest into the Roth, what is going to happen inside of that? You know, what's going to lead to a taxable event, or is there any taxable events once you put the money in there?
So I like to use an analogy to describe this. So picture you have your Roth IRA account and it's underneath an umbrella. And as long as the money stays underneath that Roth IRA umbrella or inside of that account, you can have dividends, your investments can be kicking off dividends. That's not taxable. You can rebalance your account, meaning you can, let's say that you like to have a 60% stock allocation, 40% bond allocation, but your stocks have appreciated to, let's say, 70%. You can rebalance or trim back some of that risk to get you back to that 60% stock, 40% bond allocation. Not taxable. As long as it's happening within inside the account, it's not taxable. If you had a non-retirement account, that's a taxable event. Those gains would be taxable to you. So essentially, whatever's happening underneath the umbrella or inside of that account, it doesn't matter. It's only when money's distributed that you can pay taxes. And there's some very specific rules. Of course, we'll get into that as well.
Okay, so good to know that all those moves that you're making, the investment adjustments, and as you're evaluating your portfolio, those changes will not be taxable events. But you did mention distribution, so let's shift to there and focus on taking that money out, because as you build that account up again, you're going to reach retirement, need to use that for income, and figure out how to distribute that money efficiently. So are there any, first off, RMDs, the required minimum distributions that you have to take out of Roths?
So the answer is yes and no.
Okay.
If it's an account, let's say it's your Roth IRA that you've been funding throughout your working years. In that case, your Roth IRA, it's not inherited. Your Roth IRA would not have mandatory distributions.
Okay.
Now, let's say that you inherit a Roth. That's when it depends whether you're a spouse or a non-spouse, but there are specific circumstances there. Let's say non-spouse for today's purposes, where mandatory distributions would be required from the account. Again, Spouses can treat the accounts in a lot of different ways. The RMDs will be calculated differently depending on how they do that. Non-spouses are treated differently as well. So that's a little bit outside of the scope of today's conversation. We'll record an episode on that in the future as well. But if it's an inherited Roth, that's where you're going to see those mandatory distributions. If you own it outright, it's your IRA, Roth IRA, you're not going to have mandatory distributions.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewa.com or call 724-271-7019 to get started.
Okay. I know we'll probably explore the inherited aspect of Roths and other accounts down the road. So keep an eye out for another episode on that. And please subscribe to the channel. You'll be notified when that comes out. But a little bit different rules there. But best to know that if you are the owner, you establish that Roth, there is not going to be anything that's required and any mandatory distributions from that. So that's good news. All right. So along those same lines of distributions, can you just generally explain, there's got to be some kind of, to me, when you see this, it's like, how can these accounts be completely tax-free, right? The IRS has to have their hand in there somewhere. So is there any way or any type of scenario where these distributions come out from your Roth and they're taxed in some capacity?
There are. And, Ben, to your point, that the IRS, they already did, say you're working and you're contributing to the Roth, that money that you used to contribute, that was already taxed. So they already did get a portion of that. But when it comes to how the distributions for Roths are taxed, the one thing that I would want to mention first and foremost is that your contributions are always, they always come out tax-free and penalty-free. So if you put in over the years, let's say $200,000 to a Roth IRA, but the account's worth $300,000, and you decide to distribute the full $200,000, this is a little bit of an extreme example, but if you decide to distribute $200,000 from that Roth, those contributions are going to be taken out first. So the earnings would not be taken out. The contributions will be taken out first, and they will be tax and penalty free because they've already been taxed before you put the money in. So contributions always come out tax free. One other thing that I would want to mention is when it comes to Roths and it comes to distribution rules, there's really one age that you need to keep in mind, and that age is 59 and a half. Now, why that's important is the distributions are going to be treated differently if you take money out before 59 and a half and after 59 and a half. So let's just start with what happens if you take money out before you're 59 and a half. As I mentioned, contributions, they're tax-free. But if you distribute earnings, so again, going back to that example that I used, you have a Roth IRA, it has a total of $300,000 in it. We know $200,000 of that is contributions. The $100,000 is earnings. Let's just say you distribute the full account. You're under 59 and a half, so you distribute $300,000. What you're going to do is you're going to pay taxes and penalties on the $100,000 of earnings. Then if we use that same example and we look at what happens after you're 59 and a half, there could still be taxes. And where you're going to see taxes come into play is if you haven't met what's called the 5-year rule. And simply put, the 5-year rule is basically saying that 5 years need to pass after the tax year of your first Roth IRA contribution before you can withdraw the earnings tax-free. So let's say that you're, again, over 59 and a half, distribute the full 300,000, but you have not met that 5-year holding period. Then what happens is your earnings are still subject to taxes, but they're not subject to penalties. Okay. And again, the contributions are going to be coming out tax-free and penalty-free.
So the account just has to be open for 5 years, essentially. It's not every dollar that I put in has to be in there for 5 years before it can come out tax-free.
Right. I was going to plan on covering this a little bit later in the episode, but the 5-year rule is it's a little bit tricky because there's some levels to it. So for what we're talking about right now, we're talking about just, money that you've contributed just directly to the Roth, right? That 5-year holding period, basically the best way to look at it is it's going to look at when you first contributed to the account. That's kind of the simplest way to think about it. Now, we talk a lot on the show about Roth conversions. That's one of the tax planning strategies that we look at for our clients. Roth conversions, meaning you took money from a traditional IRA, presumably in lower income years, you paid tax on the distribution from the traditional IRA, and then you put it to the Roth IRA. Each conversion has its own 5-year holding period. Okay. Before that money can be fully distributed, tax-free and penalty-free. So contributions are just based on the initial contribution. Conversions have individual 5-year holding periods that you need to be aware of.
Gotcha. Okay. So 5 years, once that account's established or the conversion is made, that kind of that timer begins for that, right? So
correct.
Important to keep that in mind again in that key age, 59 and a half. And I don't think I realized, Ryan, I feel like I'm pretty well versed in the Roth, but I don't think I ever realized that the contributions can come out tax-free in time. So like if I was putting money in and all of a sudden, huge expense popped up, and again, not something you'd probably normally want to do, right? This is retirement money, you put it aside, but say something major came up and I'd put 5,000 in last year or 5 years ago or whatever it is, I can still pull that 5,000 out without any penalty.
Exactly. Yeah. And the nice thing is that it doesn't really, I mean, yeah, there's a little bit of record keeping that needs to go into it, but not a ton, because it's automatically going to resort to contributions first. When you make a distribution from a Roth IRA, it's going to first dip into your contributions, then it's going to dip into conversions, because the base amount that you convert is essentially treated like a contribution. Let's say you have, again, we'll just stick with the same example that I've been using. You put in $200,000, the account totals $300,000, but let's say that 50,000 of that was converted assets and the 100,000 is the earnings. If you took out $200,000 in this example that I'm using, the first 150 will be treated as contributions, tax-free, penalty-free. The additional 50, the converted assets, are going to be pulled next. So we're not touching earnings yet, and that will come out tax-free and penalty-free. It's once you cross over that $200,000 and you start getting into the earnings portion that you have to be aware of when taxes could be paid. So as long as you know how much you contributed and converted, the base amount, just not a ton of record keeping that needs to take place there.
All right. Good to know. All right. Well, I know you talked about as part of that 5-year rule, right? You could have some earnings that are subject to taxes, not penalties. But when you talk about taxes, is that an ordinary income tax rate? What rate is that taxed at?
That's exactly correct. Yep. The earnings are taxed as ordinary income.
Okay.
And then I know I talked a lot about the penalty as well. And if you are subject to penalty, if the earnings are subject to the penalty for you, that would be an additional 10% on top of your ordinary income rate. So definitely something you want to avoid, and definitely something you want to be well versed on so that you just aren't randomly subjecting yourself to that kind of penalty.
Yeah, it could be a significant amount of money, that 10% there.
Right.
So, again, any decisions you make with your IRAs, your retirement accounts, you definitely want to sit down with someone and talk through what your ideas are, what you're trying to hope to do, and see if there's another avenue for doing that. All right, so let's talk about then some additional considerations. We've had a pretty good breakdown so far of what the Roth is, how to utilize it, and the tax-free growth. Is there anything else? I know there's always going to be more to this, and I always encourage anyone that has further questions or specific scenarios to reach out to the Wyze Wealth Advisor team and talk through some of these things. Again, all the contact information's in the show notes here, but anything else that you think is worth covering here in this conversation that we haven't touched on yet?
No, I just, I talked about it a little bit earlier. I was going to save this towards the end of the episode, but that Roth conversion piece, moving money from the traditional IRA, paying taxes on it, and then immediately moving it to the Roth IRA, you just really want to be aware that each conversion has its own 5-year period. And then you also want to keep that 59.5 rule in place, because if you're distributing before that 5-year window has been met, and you're under 59.5, your earnings will be subject to ordinary income and a 10% penalty. And again, if you're over 59 and a half, you won't have that 10% penalty, but your earnings are still going to be your earnings are still going to be taxed as ordinary income. Whereas if that 5-year rule was met and you're over 59 and a half, the distribution is completely tax free, whether it's contributions, conversions, or earnings.
Gotcha. And then just for people that aren't that familiar with the Roth conversion, I know that strategy has come up quite a bit. It's more and more popular. I know you get quite a lot of questions about it, but just like kind of a quick explanation of how the Roth conversion works.
Yeah, it's just you have a traditional IRA, or what we see most often is people did a really good job of saving while they were working. Let's say it's a company 401k plan. When they retire, they decide that they want some additional investment flexibility. So they move out of the 401k plan and they do what's called a rollover. They roll that money to a traditional IRA or a rollover IRA. Your money's not taxed when you move it to the 401k to the IRA. And then now you're not working and you're in much lower tax bracket. We're assuming that just for the example that we're talking about, you're in a much lower tax bracket. So why not fill up those lower tax brackets while you're in them? A good way to do that is pull some money from the traditional IRA that, was originally your 401k. Again, this is all pre-tax money that we're talking about. So the money in your 401k that then goes to the traditional IRA, it hasn't been taxed yet. So when you pull it out, it will be taxed. You fill up those lower tax brackets and then you put it to the Roth. And the goal with that would be that you let it sit in the Roth for a while so that when you pull the money out later on in retirement, it's completely tax-free if you need to pull it out at all.
Yeah. Okay. Well, again, just maybe another topic we get into deeper, and I know we will talk about and touch on. But again, this is also something that you work with clients on, right? Anybody that's considering, hey, where do I need to be putting my money? What should I be contributing into now? Or that Roth conversion strategy, is this something that makes sense right now? These are conversations you have all the time with people, right?
Oh, yeah. I mean, because we specialize in working with pre-retirees or people that recently retired, it's a pretty common question that we get. Hey, should I be contributing to a traditional IRA and just lowering my income now, or should I actually realize that as income now and put it to, let's say, like a Roth 401k or a Roth IRA? We get that question a lot, and we can not only make that recommendation now, but what we can also do is we can say, okay, well, when do you want to retire? What's the income going to look like then? And we can say, we can let them know if it makes more sense to implement some sort of Roth conversion strategy then, once their income's lower and they're no longer working. So we can really map it out and see when they should contribute to what, not just now, but also whenever they retire.
Awesome. And again, the best place to start with that is that kind of that 20-minute intro call, right? That's kind of where you can kind of see how your services and what you do every day can help somebody meet their goals and come up with a planning strategy that works, correct?
Exactly. Yeah. We have a 3-step process where a prospective client can evaluate our firm, our expertise, and the services that we provide. And step 1 of the 3 is a quick 20-minute, what we call introductory call. And really what we're trying to figure out there is, what are your retirement planning objectives? And are they aligned with the areas that we help our existing clients in? If we agree that there's a good fit, that's when we would start getting into the steps 2 and 3. If we determine, hey, your objectives aren't aligned with our areas of expertise, we're not interested in growing a firm with clients that we don't think that we can help. So we would very clearly let you know, hey, we think you'd be better suited elsewhere.
Very good. Best place to start, again, wyzewealthadvisors.com. That link in the show notes as well. Plus, you can get the link that we talked about earlier with the adjusted income, tax rates, that sort of thing. You want to look through that document to reference that as well. It's all there. But again, any questions you might have, you want to follow up about Roths, the best strategies to use to save for retirement, the Roth conversion. Again, I know a big one for a lot of people right now. Get in touch with Ryan, the team there. They'll be happy to sit down with you and start talking through some of those strategies with you. But all in all, hopefully this gives you a better picture and better idea of the Roth, how it's used, how it can be very beneficial for you in retirement. And hopefully you'll look to learn more about that. Ryan, thanks for the breakdown as always.
Yeah, absolutely, Ben. Thanks for helping me work through the episode here.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.